The Bank of Japan and the Swiss National Bank have emerged as the two major central banks most likely to change course in the next 2 months, according to analysts, but in very different directions. The U.S. Federal Reserve is expected to cut for the first time in June, with markets narrowly pricing a 25 basis point reduction to take the Fed funds target rate to a range of 5% to 5.25%, according to CME Group's FedWatch tool. Minutes from the Fed's January meeting showed officials were wary of cutting interest rates too quickly, while expressing cautious optimism about the general downward trend on inflation. The European Central Bank is also projected to start cutting in June, with Eurozone inflation easing to 2.8% in January while economic growth remains stagnant across much of the bloc. The Bank of England is now expected to be among the last to begin unwinding its tight monetary policy, with a slim majority of economists projecting a first cut in August, according to a recent Reuters poll. Goldman Sachs last week pushed back its projections for rate cuts from May to June, citing several key inflation indicators that look on the firmer side. However, the Wall Street giants suggested the Monetary Policy Committee will then deliver 5 25 basis point cuts this year, compared to a market consensus of 3, taking the main bank rate to 4% by December. On the basis of market expectations, the first G10 central bank to cut rates will be the Swiss National Bank. The market is pricing around a 60% chance of a first 25 basis point cut in March, according to LSEG data, taking the SNB's key rate down to 1.5%. Swiss headline inflation fell from 1.7% in December to 1.3% in January, well below consensus forecasts, while core inflation dropped from 1.5% to 1.2%. Analysts at Capital Economics said the steep decline meant inflation looks sure to undershoot the SNB's Q1 forecast of 1.8%. Along with the fall in core inflation, we think this will encourage policymakers at the SNB to cut the policy rate from 1.75% to 1.50% at their next meeting in March, they added. Yet the jury is still out ahead of the March 21 meeting, and economists at UBS still believe the SNB will start cutting rates in June, followed by 2 more cuts in September and December for an eventual terminal rate of 1%. We think the SNB will want to wait to ensure that domestic price pressures stemming from higher rents no longer pose upside risks to inflation. Its latest forecast assumes inflation picks up to 2% in Q2. Switzerland's largest bank said in a note last week. However, with the January inflation downside surprise, the SNB forecast looks too high to us, and the probability of a policy rate cut on the 21st of March has increased. To cut rates, we believe the endpoint of the SNB's inflation forecast would need to decline below 1.5% from currently 1.6%. And the forecast path would have to become downward sloping.